Welcome back to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. We saw a good recovery in the market yesterday from the day's low. In fact, the Nifty staged a 200-point recovery from the day's low of 23,496 or thereabouts. We did violate that 23,500 mark, but it will be crucial to watch. Given the fact that we have global cues which aren't looking all that encouraging. Inflation fears are back in the US, and the rate cut trajectory is looking pretty uncertain when it comes to the US Federal Reserve. So all these factors pushed up the dollar, pushed up the yields as well, and of course equities have taken a back foot, although it was a mixed close on Wall Street. But of course the GIFT Nifty hinting at a lower start, although in the pre-open we are looking at a 20-point uptick on the index, 23,710, where that's where the Nifty is at in the pre-open. Whether or not we open with a positive bias, given the negative cues coming from GIFT Nifty, that we'll get to know at 9:15. But yes, backdrop not all that great, the global backdrop, but back home lots to watch out for. The earnings season kicks off today. That will be another thing to watch out for, and lots of stocks also in focus. So let's see whether or not we manage to defend that 23,600 to 23,650 mark or not, given the fact that there are quite a few cues to digest. But as I mentioned, lots of stocks in focus: Lupin, Tata Motors, TCS, of course, and a whole host of other stocks. All your stock related queries should also be coming in on our live feed. We'll try and take them up with our experts on the show. But of course, before we move any further, let's take a look at the top stories at this hour. Wall Street ends mixed as the Dow and S&P 500 eke out gains, but Nasdaq extends its losses from the previous session. FOMC minutes indicate higher upside risks to inflation, clouding the outlook for Fed's rate cut trajectory going forward. Asian markets trade largely lower following a volatile session on Wall Street. The GIFT Nifty is also hinting at a lower start for the Indian market. Crude prices fall on a stronger dollar and rising US crude inventory. Meanwhile, gold prices rise to a 4-week high despite the Fed's caution on inflation. Well, the earnings season kicks off with TCS set to report its third quarter numbers today. A muted quarter is expected on the back of seasonal furloughs and lower contribution from key client BSNL. And Finance Ministry reshuffles key portfolios ahead of the Union Budget. Finance Secretary Tuhin Kanta Pandey is given additional charge as Revenue Secretary. Arunish Chawla replaces Pandey as DIPAM Secretary and will also hold charge of the Department of Public Enterprises. All right, on that note, let's take a look at the cues for trade then. Last hour surge pushed the Nifty back near that 23,700 mark yesterday, although we ended flat for the day. But, it was a good close, given the fact that at one point in time, we were below that 23,500 mark as well. The broader end of the markets were underperforming. The mid-cap index ended lower by 1%, but it was much better than the kind of lows that we saw on the mid-cap index yesterday, because at one point in time, the mid-cap index was down over 2%. Reliance, IT stocks, these are some of the stocks, that lent support to the market. Reliance, in fact, was among the top contributors positive contributors to Nifty. That stock was up and about almost 2% on the back of positive brokerage notes. IT stocks also staged a very smart comeback from the day's low. In fact, the Nifty IT index, was 2%, recovered 2% from the day's low to end near the day's high. So even TCS for that matter, ended higher by about 2% or thereabouts. Aside of that, if you look at the options cues, in terms of put call ratio, marginally higher at 0.83 vis-a-vis 0.82 in the previous session. And if you look at some of the stocks that will be in F&O ban today, L&T Finance is the one that has entered the ban list. Bandhan Bank, Hindustan Copper, Manappuram Finance and RBL Bank. These are some of the stocks that will continue to be in F&O ban today. Manappuram Finance, of course, there's a positive news flow around that stock. That stock will be in focus. We'll be talking about that with our technical expert as well. But in terms of fund flows as well, FIIs remain net sellers. This year, they have been net sellers in all of the sessions. 3,300 crore rupee worth of stocks sold in the cash markets when it comes to the FII flows. Domestic investors have bought shares worth 2,700 crore rupees in the cash markets. Remember, in 2025 so far, FIIs have already withdrawn funds to the tune of over $1 billion. So FII flows continue to be under pressure. Let's bring on board our guest for today. On that note, joining me is Chandan Taparia, Senior Vice President, Head Derivatives and Technical Research at Motilal Oswal. Chandan, great to have you on the show. Speaking to you for the first time this year, so wishing you a very, very happy new year and a prosperous one at that.
And all the viewers, very happy new year.
Right, Chandan, if Sure. Thank you. Well, on that note, Chandan, let me talk to you about the market. Of course, the week started on a poor note, right? We started the week on a very negative note with a knee-jerk reaction to quite a few factors. But yesterday we saw a good recovery from the day's low. However, we aren't really being able to sustain any kind of a bounce that we see in the market, right? And today, we have TCS also reporting numbers. So in times of such volatility, what is the kind of strategy one should adopt? And 23,650, do you think this level has the legs to sustain, at least for this week?
So Nandita, if you look at the data setup in the month of Jan, Nifty usually remains volatile. As per the seasonality and the historical data of last 10 years, in the month of Jan, India week surged by more than 15 to 30, 40%. Average is 22%. And in last 10 years, 8 times Jan month was negative. So be ready for the roller coaster ride in the market in the entire this month. And I believe market already reacting in the same manner. We witnessed a sharp recovery in the last week, but that fizzled out and being sold. If I look at the price behavior of last 8 days, index recovered from 23,450 to 24,200 zone, and then again tumbled down to 23,500 and now at 23,650. So we believe that such kind of swings and volatile cues would be there in the market. But as of now, the way index is trading below key moving averages and every small bounce is being sold, we believe that till Nifty holds below 23,850 zone, we believe that downside will be there to retest the support of 23,500. So 23,850 can be used as a hurdle for the 23,500 on the lower side in the Nifty index.
All right, that's about the Nifty. Volatility is here to stay, and January, of course, being a volatile month, more volatility cannot be ruled out. But what about the Nifty Bank Index? Fairly weak. 49, we've broken below that 50,000 mark as well, and it's below that 200-day moving average as well. But, in the pre-open as well, we are seeing a triple-digit cut on the Nifty Bank Index, 49,700. That's the kind of level we are staring at. What is the kind of level you'll be working with for the Nifty Bank Index now? Do you expect lower levels, perhaps 49,500?
So Bank Nifty started to form lower highs from last 4-5 trading session, and the levels are gradually shifting lower. And earlier it was finding sustained buying interest near 50,000, 49,650, but now holding below the same. So I think after the consolidative move of last 6 months, now the breakdown is visible. And earlier the Bank Nifty was moving in a rising channel. That channel is also being broken. So multiple concerns are there, and hold below 50,000 could open the downside to 49,250 marks.
All right, that's the view. 49,250 cannot be ruled out on the downside when it comes to the Nifty Bank Index. But of course, one pocket that will be in focus will be the IT pack. And yesterday we saw a very good rebound coming in from the day's low. Given the kind of positioning that has happened ahead of TCS numbers, do you expect a sell-on rally if there is some kind of good news from TCS numbers? Do you expect a sell-on rally kind of scenario for IT stocks here on?
So IT will be mixed cues. Nifty IT witnessed some decline in last 3-4 weeks, but supports are intact. We have to be very selective in the Nifty IT name. Looking at TCS first, it has seen a corrective move from 4,500 to 4,000 marks, and now supports are there with put writing. So a recovery could be there towards 4,200 to 4,250. But again, upside will be kept, and one has to be very selective. Looking at HCL Tech, it is holding well above its rising support trend line, recently taken support at the lower band with 50-day So with support of 1895, one can look for an upside target towards 1975. So one has to be very selective in IT. TCS can see some recovery and still take looks good standing from the key support zone on the daily and the weekly scale.
Okay, that's about the Nifty IT as well as TCS in particular. But let me just take our viewers through what to expect from TCS numbers today. Of course, third quarter is a seasonally weak quarter for major IT names because of higher furloughs. That continues to cap revenue growth every quarter because, of course, of Christmas and New Year holidays. But for TCS in particular, margins are expected to get a boost from the rupee depreciation. Also, the fact that there will be no BSNL deal related costs and of course even the wage hike cost, because the wage hike was undertaken in the first quarter itself. So because of that, margins are expected to get a boost. Revenues of course will be muted on the back of lack of contribution or moderating contribution from the BSNL deal. There could be lack of major deal wins as well in the third quarter, which is why the deal TCV figure is estimated to be anywhere between $9 to $10 billion. Specifically for revenues, they're likely to be extremely flat, down somewhere on 0.06% at 64,218 on a quarter-on-quarter basis. PAT is, however, expected to grow 3% on a quarter-on-quarter basis. But on that note, let me quickly take a look at the market, because markets have opened up. We are getting the first ticks, and it is not a positive start as we saw in the pre-open. It is a 50-point cut on the Nifty as we speak right now. 23,638 is where the index is at the current juncture. And of course, the GIFT Nifty was already hinting at a 40-point kind of a cut. So yes, in tandem with what the GIFT Nifty was hinting, we have seen a 50-point cut on the Nifty. The mid-cap index extremely flat at the current juncture, but the texture is of course towards the negative side. Bank Nifty also down 0.5% or so. So we are around that 49,600 mark when it comes to the Nifty Bank Index. But let's take a look at what the other sectors are doing at the current juncture, particularly the IT pack. Flat, but is trading with a positive bias. TCS of course kicks off the earnings season. Although expectations are muted, but if there is any kind of a positive surprise, who knows, IT stocks may go higher from here. But if you look at some of the other pockets, autos are doing well, 0.5% gain coming in on that index, taking the lead at the current juncture. Aside of that, you have pharma. Yesterday, pharma was a big laggard. Today, we are seeing some bit of buying interest. 0.2% kind of an uptick on the Nifty Pharma Index. But what's not doing well aside of the Nifty Bank Index is the energy pack. Energy as well was among the top gainers yesterday. Today, under some bit of selling pressure, FMCG also saw good recovery yesterday. In fact, the index had recovered almost 800 points from the day's low. But, some bit of a selling pressure coming in there as well. Infra pack is also trading in the negative zone, and so is the metal pack. It's trading with negative bias, 0.2% lower on the Nifty Metal Index as well. In terms of individual movers, then Tata Motors, that's among the top Nifty gainers today. The JLR wholesale data came in for the third quarter, up 3%, which is higher than estimates. And, that is boding well for the stock. That's among the top Nifty gainers as we speak. Bajaj Auto, that's the top Nifty gainer. M&M also extending, up move, almost 1% higher on this one as well. So top three gainers on the Nifty are from the auto pack, which is why we are seeing a 0.5% uptick on the auto index. Kotak Bank from the banking pack is doing well. The stock has been in a spot of bother after a top level exit. Asian Paints, yesterday it was in the green, today as well. Hindalco, some bit of news flow in terms of its arm Novelis. So that stock also doing well. Infosys and TCS as well in the positive zone. What's not doing well? SBI, top Nifty laggard, almost 1% lower on that one. HDFC Bank as well, ICICI Bank. So all the other banking names are under pressure, barring a Kotak Bank. Adani Ports, Wipro, L&T, Nestle, these are some of the other laggards. But looking at the open, Chandan, very quickly, what would you recommend in terms of picks, with the kind of open that we had this morning?
Yeah, so Nandita, looking at the selective stocks, I believe one has to be very selective in this market. Index is slightly down and level are gradually shifting lower. To start with TCS first, Uh, it started on a flattish note. We believe some recovery could be there, but broader market is not supportive. So upside is going to be kept. As of now, I'll look at the key support near 4,000 with hurdle at 4150 or 4180. So I'll play that range. Rather than going for option buying, we'll go with bull call spread kind of a strategy with the view that theta decay could be there in the counter. Looking at other name, as I mentioned, SL Tech, where I'll keep on radar. However, it opened on a slightly muted note, but need to look at the key support zone. After a long time, we are turning positive on selective chemical name, including SRF, Navin Fluoro, Deepak Nitrite, and all. Even so, one can look at here. However, SRF and Navin are up by more than 10%. So other name could be on radar. I can focus on Deepak Nitrate with support of 2450. One can look for a reversal towards 2600 zone. So this is how we need to plan. And UPL could be other name. Somehow I'm finding a theme at chemical name. So UPL is other name with support of 535. It can head towards 565 kind of level.
All right, some chemical names, on Chandan's list on that note. But let's also talk about Tata Motors, among the top Nifty gainers today. But if you look at the long-term charts or 3-month charts, 6-month charts, you've seen the stock being stuck in a downtrend. Some good news in terms of JLR wholesales; they are above estimates, and of course it would bode well for the company as well. But we have a few positive brokerage reports also on the stock. Let me just quickly take you through that first, and then we'll come to Chandan and ask him about the kind of levels one should be watching out for. So Morgan Stanley has an equal weight rating on the stock. The target price is at 920 rupees. The Q3 wholesales mix and leverage will be offsetting higher incentives going forward, according to Morgan Stanley. The wholesale volume growth was nearly 2% ahead of Morgan Stanley estimates, and Morgan Stanley is also expecting JLR to post EBIT margin of 9.6%, and which will enable it to meet its overall FY25 guidance of 8.5%. The margin guidance for JLR over FY25 to FY26 will be the key to watch out for going forward. According to Nomura, well, it has a buy call on the stock. Target price is at 990 rupees. And they pointed out that only North America and Europe are some of the regions that have registered growth for JLR. They are expecting positive free cash flow of somewhere around 250 million pounds in the third quarter, led by higher volumes. And they are expecting the company to move from net debt of 22,000 crore rupees in the second quarter to net cash of 86 rupees per share by FY27. And they've also pointed out that the valuations are looking pretty attractive. But looking at the charts of a Tata Motors, as I mentioned, the stock has come off quite a bit from its highs. Are you spotting some signs of a turnaround on the charts? Has it seen the worst of the movement on the charts?
Yeah, so getting the sense of some recovery in the counter. If I look at the past almost 6 months, Tata Motors had seen a corrective move from 1176 to 717 marks. Now it has been finding higher tops, higher bottom on the daily and the weekly scale. The stock is struggling near its 50-day exponential moving average after almost 85 trading session. So small follow-up can lead the counter to higher zone. So we'll go with as a buying approach in Tata Motors, can use any small decline for buying activity. As of now, the support is at 780. Use any dip with support of 780 for an upside target towards 828.35 marks.
All right, that's about Tata Motors. But what about a Manappuram Finance? Of course, it is reacting to positive news flow. The RBI has lifted supervisory restriction on Ashirwad Microfinance, which is its micro lending arm. The RBI is satisfied with the submissions and adoptions of the revamped processes. In fact, in October, the RBI had asked 4 non-banking financial companies, including Ashirwad Micro, to cease and resist from sanctioning and disbursing loans from the 21st of October. It had found material supervisory concerns in relation to high lending rates. The stock of Manappuram Finance, it has seen good traction if you look at the last 1 month. Do you think, the kind of bounce that we have seen in the stock today, does it position it for further up move from here, or do you think that all the good news is in the price and perhaps it could be poised for some bit of a cool off after the recent up move?
Manappuram has seen the buying interest even on the last day. It tested the key support near 177. That is a key moving average. So I believe positive to range bound bias could be there. The stock is up by more than 5%. So wait for a small cool down in the price and then go for buying opportunity. So with support of 183, overall we are expecting 200, 203 kind of level in this counter.
Okay, that's about Manappuram. Another stock that's up 0.5% or so from the pharma pack, that's Lupin. It has got the US FDA EIR for its Pithampur unit with voluntary action indicated classification. The inspection was done between September 16 to 27th, and it had ended with 6 observations. But this is a good news for Lupin. The stock is up somewhere around 0.5% or so. But if you look at the stock, 2025 hasn't really started on a good note, right? Last five sessions we've seen the stock, trading in the red, and gains have also tapered a bit in the last 3 months. Within the pharma pack, would you look at a Lupin or would you look at something like a Biocon that has seen a spate of good news and the stock is doing well?
So looking at Biocon first, I'll go with Biocon comparatively. Lupin has seen a decent up move, but last 5 days were crucial for the counter where the stock witnessed a build-up of short positions and the stock has seen a corrective move. So, but Biocon is comparative stable in this market, and we need to find out the margin of safety rather than looking at the momentum and the high beta name. So Biocon has been witnessing positive to range-bound bias with support of 362. One can see a recovery towards 385 in the Biocon.
Okay, Biocon, a preferred stock over Lupin. But let's shift focus and get in some viewer queries answered. Then, the first one is coming in from Raja Pasala. He wants to know your thoughts on Equinox India. If there is any chance of a further up move, because the stock has seen very good traction. If you look at the last 5 days, it has gained in excess of 12% or thereabouts, and even the 1 month chart shows a good 9% uptick. Uh, do you see chances of higher levels? 164 is a 52-week high. Could it retest those levels in the coming days?
Yeah, so structure is very positive. In fact, the most of the mechanical indicators are turning on the bullish stance. Uh, we have noticed that every intraday decline is also being bought. So one can focus on it. However, we have the limited data setup, but yes, the price pattern indicates a bullish stance. Can look for an upside move. Use any decline towards 138, 139 for buying activity, and look for a target towards 147 to 152 marks.
Okay, that's about Equinox. Hope that answers your query. The next one is coming in from Naveen, and he wants to know your thoughts on a Dixon Technologies. Of course, yesterday we saw a very heavy fall in some of these EMS names, and Dixon was down somewhere around 8% or so. These EMS stocks have seen a stupendous rally, right, in last year. They are all multi-bagger stocks, so to say. But the recent, downtrend that we are witnessing in some of these stocks, would you look at, that as an accumulating opportunity? Or would you say that there are chances of more downside and perhaps one should wait for the stock prices to cool off a little more?
So Dixon has really seen a good momentum in the last 2 years. Here in this week, it is down by more than 8-9%. Some sort of profit booking is clearly visible. So I think the way it failed to hold above 19,000, turning lower, may retest the key retracement zone. So I'm waiting for a decline towards 16,000 or 15,800 to accumulate this counter.
Okay, looking at levels of 16,000 to accumulate that counter, that was about Dixon Tech. We have a few, multiple people asking about this query. Ramchandra Ramdas, in this particular stock, I mean. Ramchandra Ramdas as well as Naveen. I hope that answers your query. But let's move on to the next one then. I can see a query on a first source from Shweta. She wants to know your thoughts on this particular stock. She has bought the shares at 398 rupees and she wants to know the view for the next 6 months. Where do you think the stock is headed from here?
So yes, to reply on the query of first source, FSL, yes, major trend is positive. Every small decline is being bought. In fact, it has seen a wonderful recovery and momentum as well in last almost 7-8 months. So major trend is positive till it holds about 385. Use the support of 385 to drive the rally towards 420 marks.
Okay, that's the view on a first source. I hope that answers your query. But let's get in the query on Nalco as well. Nanda Reddy has written in, wants to know your thoughts on this stock, whether it's a good time to average it. Nanda is making a loss of 7% down, 7% on the Nalco investment. The stock has seen, in fact, has got badgered. In the last 1 month, it has shed 20% or so. How should one navigate? Should one average, or how should one really cut their losses on this one?
So the stock is making lower top, lower bottom from almost 5 weeks, and corrected from 260 to almost 200 zone. So structure is weak. First advice, don't average it. Second, wait for more decline towards 192, and that may be level to average or to buy it new quantity.
Okay, don't average it. That's the view. Hope that answers your query. I also want to get in your thoughts on a Tata Elxsi. The company will be reporting numbers today along with TCS. Tata Elxsi, your thoughts on some of these mid-cap IT names? Tata Elxsi right now is completely flat, and the last 1 month also has seen somewhere around a 12% cut. In fact, you can see that the stock has been in a downtrend. Even in the last 1 year, it has shed somewhere around 25% or so. Do you think, it has entered the oversold zone? Do you think here on they could see some bit of an uptick once the results are out of the way?
So structure is slightly weak. In the beginning of December, it witnessed a recovery, but again, from last 5 weeks, levels are gradually shifting lower. So I think need to wait. 6,000, 6,100 could be an important zone to accumulate this counter.
Okay, take note of that level where you can look at buying the counter. But let's take a query on Crompton Greaves as well. This one is coming in from Nilesh Jain. The stock hasn't done much in the last 5 sessions. I can see an 11% downtake in the last 1 month. In fact, hasn't been able to clear that 400 mark of late. How should one approach this stock now?
So looking at this name of Crompton, we need to understand that stock is in downtrend, making lower top, lower bottom from almost 4 months. Major trend may remain positive, but short-term trend is slightly shifting lower. So with hurdle of 374, it can go down to 350 marks.
Okay, it can go down to 350. That's the view, and that was the last query for today. Then, if you couldn't take up your query, don't worry and don't fret. Keep them coming in. We'll try and take them up tomorrow with our technical guest on the show. But with that, Chandan would like to thank you for taking out time and joining in this morning. Look forward to more interactions and wish you a very happy new year. Going forward.
Thank you so much. Have a great time.
Thank you. Well, on that note, almost a 100-point cut coming in on the Nifty. We are below that 23,600 mark. So whatever recovery we saw yesterday, has kind of not had the legs to move forward. Global cues also not looking all that sanguine, which is why we are seeing stocks under pressure. But of course, on the threshold of the earnings season today, TCS will officially kickstart the earnings season. and to understand what to expect from the third quarter earnings, what to expect from the IT space, from TCS itself, and where should one look at outperformance coming in this particular quarter. For that, let me bring on board Mayuresh Joshi, head of equity research at William O'Neill India. Mayuresh, great to have you on the show. First of all, wish you a very happy 2025, a prosperous one, and one where you get the time to travel, invest, and do all the things that you love doing.
Morning, Nandita. I think here's wishing you, the entire team at Money Control, all your viewers, a very, very happy, healthy, and a prosperous 2025. All your dreams come true.
Right, Mayuresh, let's get down to business then. We had a good start, so to say, to the year, but, the mood has been completely spoiled. We have, the GDP growth estimates coming in, that spoiled the mood, and, FIIs have once again turned sellers. Slowdown pangs, a lot of things at play, right? And global cues also, little shaky now that inflation concerns are back in the US. We are also starting the third quarter earnings season. That would be the major catalyst ahead of budget. First of all, how should one be navigating this volatility? Is it not the time to deploy cash? Is it time to sit still, stay on the sidelines and wait it out at least until budget before deploying cash?
So, Nandita, I think there is a two-phase answer to your question. One, I think in terms of volatility, the volatility might very well continue in the first quarter of this fiscal for all the pointers that you probably mentioned. Earnings is obviously going to be a key for equity markets. And going by how Q2 has panned out, a large part of market expectations as a base case scenario is that earnings might remain soft for most pockets in the market itself. On top of that, you're probably seeing inflation being sticky all across the globe, being reflected by the bond yields, and specifically the long tenor bonds, which are clearly indicative of the fact that if inflation remains sticky, the expectations in terms of an easing cycle might get delayed or prolonged. The third is obviously geopolitics and the warlike situations that you've probably seen across the globe. That can also have a say in terms of how the overall growth dynamics will play out. So the typical argument between growth and inflation is going to play out in 2025 as well. And let's not forget, once Trump resumes office on January 20th, what kind of a policy rhetoric does he probably pursue? You've already started hearing about tax cuts, you've started hearing about wage increases. Does that have a significant impact in terms of inflation? Does that have a significant impact in terms of global growth? And therefore, I think will earnings probably remain patchy for a prolonged period, or would it be more or less a quarter or two's affair? Is something that the markets are probably trying to gauge over the next few months. So to answer your question, expecting a large part of the market to remain volatile, at least for the first 3 months. Obviously, the budget is something to look out for on Feb 1st. And again, there are large expectations laid out, as always, in terms of capital spending, in terms of revenue spending, the deficit target, the government borrowing program that they will adopt. But I think if there is some element of tax relief that is granted specifically to the middle class, consumption, which has clearly been lagging, should see some element of respite, at least in the Indian context. So our take is that we see the markets in a confirmed uptrend, as our data points are showing at this juncture. Being sector specific and a little bit stock specific, specifically on the domestic side, because that is the impetus that we feel both through government incentives on capital account spending, some part of private capex coming back, and expectations of earnings stabilizing as we head into the first half of the next financial year should provide support for domestic cyclicals. So our take is be sector specific, be stock specific, focus on leadership stocks. I think that is the way to approach 2025. So the first quarter is going to be extremely tough and volatile.
Sure. Be sector specific, be stock specific, but let's, focus on earnings, earnings season that kicks off today. IT, sector will be in focus. It is a seasonally weak quarter for IT, as we all know, but the positioning, if you look at the positioning as we are heading into the earnings season, that's pretty much on the positive side for IT in particular, right? Because if you look at FIIs, positioning. In the month of December, they had turned buyers. 2/3 of the money actually went into IT stocks. So they took a bet on IT stocks. If there is any slightest disappointment coming in from at least the large cap names, do you see the vulnerability to a renewed sell-off in the sector? Because of the last 6 months, this sector has done particularly well.
Oh, absolutely. I think the bias was clearly towards the IT sector over the past few quarters. And it also becomes a natural hedge when markets start turning volatile. So I think the typical sectors that become a natural hedge becomes IT, FMCG, to a certain extent, pharma. You're obviously seeing slowdown in large part of the consumption basket. So FMCG might continue its underperformance. But pharma and IT probably are reflecting the kind of expectations in terms of the optimism relayed to stability in earnings, which a large part of the market might not reflect. Coming to IT specifically, Nandita, I think expectations largely, yes, it's a seasonally weak quarter. Everybody's aware of that. And everybody is looking forward for management commentary as well. Again, a large part of discretionary budgets which get decided happen in this quarter as far as US and Europe is concerned. And therefore, how the environment is shaping up seems to be pretty decent, because if you probably look at a lot of management commentaries at the exit of Q2, specifically mid-cap IT companies, they sounded very, very optimistic in terms of orders remaining strong and stable, pricing remaining very, very robust, and therefore the EBIT margin performance expected to continue at a decent pace. Having said that, valuations generally for the sector are sky high. If you compare the last 5 year standard deviation averages as well. A large part of the mid-cap universe is trading in late-stage basis as we see it. And therefore, to answer your question, if earnings disappoint to what the street probably perceives or believes, you can see a knee-jerk reaction happening on these stocks as well, because they are priced to perfection, in my opinion, whether they're large caps or mid caps. So to that extent, the argument again, mid cap might continue outperforming, as I've always maintained. Valuations sky high compared to large cap IT and for the sector as a whole. Therefore, you have to keep a watch in terms of earnings. Do not have a preemptive notion for the sector as a whole. You'll have to take each stock with earnings as it comes. But relatively, in my opinion, mid cap might outperform large cap. Some stocks within the mid cap IT space to be kept on your radar might be stocks like an Emphasis or a Coforge, where our belief is that earnings might hold up looking at what the managements have hinted in the previous few months.
Mayuresh, we'll touch upon the mid-cap IT stocks in just a bit, but I want to get in your thoughts on TCS in particular. Revenue growth is expected to be muted, lack of contribution or moderating contribution from the BSNL deal. But margins are expected to edge higher. In terms of management commentary, what would you really watch out for? Because now, as clients draw their budgets for the year, we are getting inflation concerns back in the US, fewer rate cuts. Do you think that would impact client budgets or continue to keep client budgets on the lower side? Because that is one reason why, the rate cut cycle starting in the US. That's why we saw the managements turning, bullish and the commentary turning positive. But of course, there is strength in the US BFSI space as well that is expected. So a lot of conflicting factors at play. So in terms of management commentary, what really should one be watching out for?
So I think three aspects generally for TCS and the sector as well. One, in terms of order flows and pricing related to these orders. Are you seeing some element of pain points on both these aspects? Are clients deferring orders with the expectation of what is expected to happen in terms of tax rates, in terms of developments on a micro scale as far as the US markets are concerned, or for the Eurozone in general, is to be seen. And what happens with pricing? Is pricing expected to remain far more consistent? The second, obviously, is the bench strength. So what is the utilization rates and levels that these large cap behemoths are probably looking at this juncture? Because I think that gets a fair amount of reflection in terms of how the orders are probably coming through, the execution of those orders as well. And obviously, I think how that translates into the overall bench strength dynamics. The third, obviously, is expectations in terms of the EBIT performance itself, because that is one key benchmark that the markets probably look forward for. And if the expectation is that Trump continues with the policies related to H-1B, there are no additional costs when it comes to outsourcing or otherwise that these companies might have to take on their books, which might have some element of dent on their margins. And with the margin outlook seems to be plausible, I think that might create some element of respite as far as future earnings are concerned. So I think it will largely revolve around these three broad aspects. If these three broad aspects are well addressed and an optimistic note is given out, I think the street should take results with confidence.
I want to ask you what should be the pecking order for these large cap IT names, because you've seen stocks like Wipro outperforming despite EPS cuts, right? Despite negative growth. Even HCL Tech, of course, HCL Tech's products business does particularly well in the third quarter. So that's also poised to do better when you compare to other large cap peers. So what should the pecking order be right now when it comes to the large cap names, the big four, so to say?
So I think if we map our own dynamics in terms of EPS ratings, RS rating, institutional holding, a lot of parameters that we look at for in cancel limit market space in India, our take is that within the large cap names, the positioning of Infosys probably remains right at the top, followed by HCL Tech, TCS, and then Wipro.
All right. Last question then, coming to the mid-cap IT pack, stocks like Persistent and Coforge, I mean, these are among the mid-caps that are expected to post good 5% growth. In fact, these two stocks have been ranked outperformers. If you see 60 to 70% kind of returns over the last year, do you see more headroom for upside, or do you think the fact that these companies will report good earnings is already factored in?
So again, as I said, they're priced to perfection, Nandita. So I think they have to outperform street expectations to a large extent. And therefore, as the base gets built up higher and higher, what kind of outperformance can they deliver? Is this something to be watched out for? And therefore, as I said, late stage basis, valuation sky high. Is this something to be noted from an investor perspective? I think within the space, as I mentioned, emphasis is something that can be put on your watch list. Obviously, I think the kind of work that they are doing in terms of generative AI, a large part of that portfolio pool, almost 35%, is Gen AI generated, and that percentage is expected to edge higher as we head into the next few quarters. The management believes the EBIT margin that they'll maintain between 14.5% 60%. Largely, my belief is anywhere between 15.5% should be maintained. They have decent order wins in the first half, in excess of $550 million dollars. Well spread out between client buckets. And the management commentary sounds very, very optimistic. So I think Gen AI is the buzzword for IT. Tech disrupting tech, as emphasis is put down on its opening slide, is a very appropriate slide, is what I feel. And any companies which can crack this code in terms of exceeding client expectations and delivering much more than what was asked for, you're probably going to get much more in terms of orders, better priced orders, better margin orders. And as that percentage starts moving up in terms of your overall book across sectors, that might be a game changer on what transition you've probably seen the entire sector go through from Lean Sigma, Six Sigma, to data processing, outsourcing, to Gen AI, where we probably stand. So I think if I have one stock on the watch list when mid-cap IT at this juncture, it would be emphasis.
Okay, emphasis that stands out for Mayuresh. But Mayuresh, so far the kind of third quarter updates that we've got, banks have been fairly mixed. If you look at HDFC Bank and Union Bank, of course, HDFC Bank has its own set of challenges and stuff to work on in bringing down its loan to deposit rates. But Union Bank as well, we saw weakest amongst banks, right? IT seasonally weak. Of course, mid-cap IT may outperform. But which are the other pockets where you see some bit of earnings visibility, at least for the third quarter?
So is this related to banks? Because I could not hear the question properly.
I think there was some bit of an audio issue. I really couldn't get that answer, but I think I'll touch base with you, pretty soon, and we will discuss more earnings as and when they trickle in. But with that, Mayuresh, would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. I look forward to interacting with you, very frequently this earnings season.
Sure, more than happy to join you on a regular basis.
All right. Well, on that note, let's just take a look at the market. 70 points or 75 points down at the current juncture. We are hovering around that 23,600 mark. 0.3% kind of loss coming in at this juncture. But whether or not we manage to defend that 23,600 mark is something that we'll be watching out for rather. But mid cap index has pared some of the losses, outperforming the benchmarks as of now. Nifty Bank also has managed to pare some of the losses, and among stocks that are managing to hold out in a weak setting are the likes of Kotak Bank. In fact, now it is one of the top Nifty gainers. Some of the auto names, Bajaj Auto and even Hindalco, on the back of the news flow on Novelis, it has been holding out. But I think TCS has slipped into the red ahead of earnings. So yes, setup is weak, but let's see how we fare as we move forward. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. But you guys stay tuned to Money Control. Busy day. We'll have closing bell at 3:30 p.m. and then we'll also be getting you an expert analysis on TCS numbers post it declares its earnings. Well, on that note, thank you, goodbye, and see you soon.